Have you ever wondered how to invest wisely without losing sleep over market crashes? Benjamin Graham, the mentor of Warren Buffett, wrote The Intelligent Investor to teach us exactly that. And no, it's not about getting rich quick. It's about how not to be stupid with your money. Lesson 1. Don't be a speculator. Be an investor. Let's say a new stock just launched, Stellar Blade Corporation. They made an insanely popular action game that just blew up on Twitch and YouTube. Streamers love it, fan art is everywhere, and it's the internet's new obsession. Adam the speculator sees Stellar Blade trending on social media. He buys the stock immediately because he believes it's going to go viral, and he is planning for a quick take profit before the hype dies. Adam doesn't know if the company has any other plans for new games coming up, whether it actually makes money, or if they spent way too much on marketing just to sell one title. He's just riding the hype train, hoping he gets off before it crashes. On the other hand, Eve the investor digs deeper. She checks how many units the game sold in the first month, if Stellar Blade has a solid development team and future games lined up, and if the stock is trading below what she thinks the company is worth in the long term. After doing thorough research, Eve the investor finally decided to buy the stock. But Eve has planned to hold the stocks for a few years because she believes that Stellar Blade Corp looks really sustainable. Now imagine the price dips the next week after the game hype fades. Adam the speculator would have sold his stocks to cut his losses. Eve the investor would buy more to average down because she sees it as a solid company and fluctuations in prices are normal. At the end, Adam chased the hype and paid the price, while Eve played the long game and stayed calm. That's the difference between a speculator and an intelligent investor. Speculators react to emotions, trends, and noise. Investors act on research, patience, and logic. Lesson 2. Use a margin of safety. The margin of safety is your shield. It doesn't guarantee success, but it greatly lowers your chances of failure. Let's say you're researching a company called Amelia Games, a public company that makes popular games. After digging into their financials, revenue, profit margins, assets, and future games, you estimate that the company is worth around $100 per share, but right now, the stock is trading at $65 per share. Why? Maybe the overall market is down, or maybe there was some short-term bad news like a game delay. But nothing that changes the long-term fundamentals. So instead of buying Amelia Games at its full estimated value of $100, you're buying it at a 35% discount. What are the benefits, you ask? Consider that $35 off price as a cushion to protect you if the company's next game flops, the market stays cold for a while, or your valuation was a bit too optimistic. And even if at the end, Amelia Games ends up being worth only $85 per share, you still bought at a smart price. And that's the power of the margin of safety. To be honest, after personally reading this part of the book, it's basically a no-brainer, as you should never buy a stock when it's at its highest price. Always aim to buy a stock at its lowest price, and sell when it's at its highest, which is a lot easier said than done. Lesson 3. Meet Mr. Market. Imagine you own a small piece of a company called Speculator, a tech startup that makes high-end gaming monitors. Every single day, your business partner, Mr. Market, comes knocking on your door with an offer. Hey, do you want to buy my shares of Speculator, or sell me yours? Mr. Market is incredibly emotional. His mood changes based on headlines, tweets, rumors, or even how his morning coffee went. On Monday, he's hyped. On Tuesday, a game reviewer complains about a dead pixel, and he freaks out. On Thursday, the company announces a new partnership. Every day, new price, new emotion. But here's what you need to remember: you don't have to accept his offer. You can just wait, and act only when the price makes sense to you. So what does the intelligent investor do in this situation? You must stay calm while Mr. Market goes wild. When he's panicking and offering shares at a cheap price, you buy if the business is still strong. When he's euphoric and offers to buy your shares at an inflated price, you consider selling. You don't follow his emotions. You use them to your advantage. This happens in the real market all the time. A company can drop 30% in a week just because of one bad news story, even if the business itself is still healthy. That's Mr. Market having a meltdown. The intelligent investor says, "Thanks for the discount. I'll take a few more shares." Lesson 4. Value over hype. Benjamin Graham teaches that the intelligent investor focuses on the intrinsic value of a company. How much is it actually worth based on earnings, assets, and future potential? He warns against chasing hype, buying stocks just because they're popular or trending, because hype fades, but value lasts. The key is to buy companies that are undervalued by the market, even if they're not exciting. Let's talk about two companies. Anitech, a flashy tech startup that's all over TikTok. Waterwall, a boring-looking company that sells cybersecurity tools to governments. Now, Anitech just dropped an AI-generated dating app with anime voice filters. The internet goes nuts. Everyone's putting their life savings on Anitech. But here's the thing, Anitech has no real revenue, just followers. It burns cash and depends on attention to survive. Meanwhile, Waterwall has consistent revenue from long-term contracts and real profits every quarter, but no one is talking about it on social media. The intelligent investor would ignore the hype and buy Waterwall, because it's a real business with real value. And when the hype dies down, and trust me, it will, those who had bought the stocks of Anitech would be in deep trouble. Lesson 5, Master yourself, not the market. Benjamin Graham says your biggest enemy in investing isn't the market, it's your own emotions. Fear, greed, panic, and impatience lead to bad decisions. Markets will always go up and down, but the intelligent investor stays calm, rational, and sticks to their plan. Let's say you bought shares of Soundcore, a headphone company with strong sales and solid long-term growth. Suddenly, the market crashes 15%. The news are everywhere and everyone is selling. In results, Soundcore drops by 30% in a week, but after doing your research, you found out that the company itself is still doing fine. In this situation, an investor who has not mastered himself or herself would sell in a panic to cut losses. But the intelligent investor? They stay calm, remember their research, and maybe even buy more, because nothing changed about the business. They perceive it as an opportunity, not a chance to get away. Lesson 6. Choose your own strategy. Benjamin Graham says there are two types of investors. Defensive investors are those who want a simple, low-effort strategy. Active investors are those willing to put in time and research into their strategy. The intelligent investor knows which path suits them best and sticks to it. Now let's meet again with Adam and Eve. Adam is a defensive investor. He doesn't want to monitor the market every day, so he invests in index funds like the S&P 500 and blue-chip stocks. His strategy is boring, but steady, and he sleeps well at night. On the other hand, Eve is an active investor. She enjoys digging into company reports, spotting undervalued stocks, and building a custom portfolio. She spends hours researching, but she loves the process, and her returns show it. Both Adam and Eve are doing well in their investing journey even though they have completely different strategies, because they chose the path that fits their lifestyle and personality. So pick your style, be consistent, and don't try to be someone you're not.